Joining me on the Melbourne Property TV panel this week from Empower Wealth, Ben Kingsley, from the REIV, Robert LaRocca, and from Aussie Greensborough, Lockie Pittman. And gentlemen, today we're talking interest rates. The banks no longer following the RBA, not passing on full cuts, even raising interest rates in their own time. Is this the major ramification the papers are making it out to be?
Look, it's really, in some respects, the conclusion of a process this country started on in the mid-80s when, we stopped fixing the exchange rate. It's the ultimate conclusion of that. And, we do live in a global economy and it's just the next step in that chain. We can buy products from overseas at will, and we do. It makes almost no sense for the Reserve Bank to be telling the banks what to do. That doesn't mean people don't like it, though. That's just where we are, really.
Is this a game changer, Ben, do you think?
Definitely not a game changer at all. This is all hyped up into some type of hysteria. The reason why the banks have decided to go outside of the first Tuesday of every month's decision is because of the PR backlash. Everyone's waiting for the banks to make their decisions, so the banks are trying to take the heat off themselves by doing that. Now, when the banks set the interest rates, most of the other lenders are then market takers. So the big banks are the market makers, and then the rest of the lenders are the market takers. So the Reserve Bank will still consider the decisions of what the lenders are doing if they're creeping rates up by 10 basis points or whatever. But ultimately, the Reserve Bank are still in control of releasing cash in and out of the market.
So they've still got their ability to influence the economy and to put the brakes on?
Very much so. I mean, if we see interest rates go down, we see affordability improve, and we see pressures on values, and we see money in the economy is cheaper, more investment occurs, and that can stimulate the economy. The same if rates were to go up, affordability becomes less from a housing point of view, and we see a slowdown. So I think the RBA have got it right in regards to having that lever to move to stimulate the economy.
Lockie, is it your experience of it?
Well, I agree with the other two guys here, but basically the banks are all in it to make a profit. The carded rate, if you look at Westpac, for example, it's 7.46, but if you go through a broker, if you go to the bank, they won't tell you if you've got a cheaper loan. You can still get variable rate loans for 6.39% now, so fixed rates are 5.99, so if you compare back to older people when the rates were 13.5% or even up to 18%, it's still pretty cheap money. If you can fix in for 5.99 for 3 years, it's a pretty good deal.
What should people be doing, Robert? Should they be just sitting back and not getting too caught up in the hysteria of it all?
I think they should look at the interest rates we've got and realise that they are quite low historically. They're a couple of whole points below the 25-year average from the Reserve Bank's perspective. Even though the banks are charging a bit more, they are still low. I mean, people will remember the dark days of 20% plus interest rates, and we're nowhere near that at the moment. Money is reasonably affordable if you're looking to borrow to buy a home, and what we also need to realise is what the Reserve Bank is doing is balancing a number of things. And every month there's the hysteria around will the rates go up or down, but you have to take a holistic view of that as the Reserve Bank do. A statement by the Reserve Bank not to drop rates is actually a sign of confidence in the economy. A poorly performing economy means that people's jobs are at risk, which has an impact on the housing market. So we have to take an holistic view as well.
And I guess historically they may be low, but comparatively with overseas, where it's 1% or 0.5%.
Or 0.25%.
Yeah. But that's because their economies are in the toilet.
Correct. Yeah, look, I mean, the RBA has said, publicly that they're happy with the way the domestic economy is running. Now, one might argue that the eastern seaboard's not seeing that fruits of the labour, but obviously the Queensland...
Two-speed economy.
Yeah, it is. It's a well-worn message of two-speed economy, exactly right. So I think what we are seeing, what the Reserve Bank is seeing for the first time in a long time over the last 18 months is our savings, our household savings are actually increasing. Whereas we were living in a debt-ridden society pre-GFC, we're now starting to see that. And I think the Reserve Bank likes that. People are paying debt down. People are starting to get their balance sheets right.
Jerry Harvey doesn't like it. He's in the paper today urging people to buy more DVD players.
From him,
from
overseas suppliers.
Not from online either.
So, for people who are looking around now, can they still afford to drive a hard bargain with the banks? Can they still go in and... I mean, you've got to know what to ask for sometimes.
You just got to ask. I mean, a lot of the time, you've just got to ask. And most people are used to, I suppose, the way it used to be, where you had no negotiating power with the bank. You do. Ask. Go in there and ask.
And, of course, people also have got the ability to get out of there, like switch banks or switch loans now, which has been made a lot easier for them.
It is easy, but it's still a big exercise to change banks, change loans. You know, they may have removed a lot of the impediments from a financial perspective, but it's still quite time-consuming to go down that process. So, you know, if you can negotiate a better rate with the bank you're at, it's probably easier for your life, but, you know, you can move too.
Are the banks competitive enough, do you think, with each other?
They are, like a sort of dog-eat-dog world out there. If you've got an existing loan, the bank most times, without swapping it to another lending institution, they will reduce the rate to match their competitor. And similarly, as Robert just said a minute ago, people can swap around, but the biggest impediment to a lot of borrowers is a thing called mortgage insurance. So they've got over 80% lend against their property. They can't swap the mortgage insurance over, so they're really not going to save anything. So they're better off just trying to drive a better deal with their existing banker or lending institution wherever they go.
What sort of deals have you heard? You know, what can people get when they go in as opposed to the advertised rate?
Yeah, look, lending over 250 and then over 500, they have different ceilings. At the moment, we saw at the start of the year, we saw anything up to 1% for lending greater than 250,000. Now we're seeing those sort of 1% margins touted around the $500,000 in lending. So as Lockie was saying, I mean, it's best to shop around, and obviously a mortgage broker is a great point to start because, you know, they have multiple lenders on their panel and they'll be able to give you a lot of choice in one location.
What questions should they be asking their mortgage broker, Lockie, to make sure they're doing okay out of it?
Well, the first person that comes into us each day wants to know, can they get a better deal wherever they can, but most times we can do a better deal, and if you go to a bank, they won't tell you if your competitor's got a better rate. So if you go to a broker, whether it be Aussie or Mortgage Choice, you will get a better deal, and generally the people are more passionate about what they're trying to provide. Where bank staff generally just a 9 to 5 type person. If you go to a broker, they'll try and get the best deal for you and do what's best for the client, not best for them.
Best place to go for a bit of overall advice before you tackle the whole getting a loan or going through a broker or approaching a bank?
Look, I think a lot of it's got to come from the personal experience. You do have to actually spend that time as a home buyer or home owner with a mortgage, understanding the differences out there yourself. You really need to sit down and do that homework first. Just like buying a home, you need to look at the different banks, talk to the brokers and form your own judgment first.
Where are they going, interest rates?
Oh, look, I think in the second half of the year we'll see some pressures on interest rates coming down, so it's still probably a downward cycle at this stage, but I think the Reserve Bank are happy. They're going to be watching Europe. Europe is the trigger. Greece is obviously the trigger. It's a well-worn. We're a little bit over, but Greece is the word.
I keep on saying our interest rates are quite affordable and quite low compared to where they have been in the past, and people need to, I think, focus on that and look at the wider economy and see it in context and realise we're far better off in Australia having a well-performing economy where people have got jobs and the interest rates are where they are at the moment. You know, if the Reserve Bank had cut rates in February, as everyone was thinking that they would, it would have been the lowest cash rate in over 25 years since the early 70s. So that really puts that into context and where the rates are now.
Lockie, that'd be your view, that we'll stay around the same and maybe some easing in the second half of the year?
I think so. I think the variable rates will drop a fair bit, but the fixed rate, I think, will probably edge up a little bit because the bank's under a lot of pressure to refinance their own global loan book. So I think you'll find some upward pressures on the fixed rate. So I think if you want to be certain, fix it in for 3 or 5 years, at least you know you might be paying 6%, but you know where it is. If it goes down a bit lower, too bad, but at least you've kept your downside.
Gentlemen, thanks for joining us on Melbourne Property TV. We'll be back with more in a moment.
Thanks, Tess.